Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we look at the latest on the global credit crunch, which is driving interest rates and currencies on both sides of the planet. This morning, the Kiwi dollar jumped through 79 US cents because our interest rates look much more attractive than those rates falling in America. Then we'll look at the outlook here for inflation and interest rates. In particular, we'll preview key inflation figures due out on Thursday. Firstly, let's look at the credit crunch and at Citigroup, which has been the source of so many fears about this credit crunch in recent days. It is expected to announce tonight its largest loss in its history, along with 24,000 job losses, as it clears the decks of subprime bonds linked to defaults on US mortgages. That's 7% of its workforce, and shows just how serious the situation has become as it looks to conserve cash and bolster its balance sheet. Meanwhile, Citigroup's hopes of finding up to $2 billion from China's development bank have been dashed. It is now expected to ask its Saudi shareholder, Prince Al-Walid bin Talal, to provide more than $10 to $15 billion of cash it needs to increase its reserves. The Wall Street Journal reports that Chinese authorities are worried about more political backlash linked to its sovereign funds investing in US financial institutions. Meanwhile, the fallout from the credit crunch continues to dominate financial market activity. The size of the write-offs and the problems faced by several large banks are now expected to force the Federal Reserve to cut official rates by 50 basis points to 3.75% when its rate-setting committee meets on January 29 and 30. Some are even wondering if the Fed will act earlier than its regular meeting and increase the rate to an unprecedented 75 basis point cut. This has driven stock markets higher and shunted the gold price to a record $910 an ounce. This is partly linked to a slump in the US dollar to near record lows, as the prospect of lower interest rates makes that currency less attractive. Of course, the other side of the coin is this makes the New Zealand dollar even more attractive, particularly for those people doing the carry trade. This morning, the New Zealand dollar jumped through 79 US cents and is now just below its record high of just over 80 cents. It's also affecting interest rates both on wholesale markets and for retail investors. Yesterday afternoon, BNZ increased its mortgage rates, following ANZ, National and Westpac, who are hiking rates because of the credit market turmoil. Now let's look at the inflation outlook here and what that means for interest rates. The big picture is that Reserve Bank Governor Alan Bollard is up against the wall when it comes to the inflation outlook, and he's under heavy pressure to keep interest rates high to dampen those inflation pressures. The trouble is, there are also signs of a slowing economy, both here and in the United States. There's nothing worse for a central bank than stagflation, rising inflation and slowing growth. The last time we had that was in the 1970s and early 1980s, coincidentally around the time when oil prices spiked to close to $100 a barrel when you adjust for inflation. So how much room does the Reserve Bank have to move? Not much, it seems, if the views from economists are anything to go by. We've polled the economists and come up with the interest.co.nz consensus of forecasts for inflation in the December quarter. We'll get the actual inflation data on Thursday, but the consensus is that consumer prices rose 1% in the quarter and were up 3% for the year. That's right at the top of the Reserve Bank's target for keeping inflation between 1 and 3% on average over the medium term. It's also a big spike from the September quarter, when prices rose 0.5% for the quarter and were up 1.8% for the year. So that means up from 1.8% to 3% just in one quarter in annual terms. And that's partly because the low December quarter figure drops out, but also we've seen high oil prices and high food prices feeding through into inflation. Economists believe the Reserve Bank will keep the official cash rate on hold when it makes its next rates announcement next Thursday. But the views are split on what it will do later in the year. Largely, the deciding factors will be how serious the credit crunch gets globally and how much the US and Asian economies slow. The views range from Brendan O'Donovan at Westpac, who sees 2 more rate hikes this year necessary to contain inflation, to Goldman Sachs' Shamu Akwab, who sees a rate cut in the second half necessary to stimulate a slowing economy. But whatever the outlook, Thursday's inflation numbers will give interest rate watchers a clearer view. I'm Bernard Hickey for the Daily Briefing from interest.co.nz.